Hey everyone, good morning and thank you for tuning in. It is a few minutes of 6 a.m. Thursday, middle of September, and I'm going to go over a trade I have in Bitfarms, symbol BITF. And as we look here at a brief description of the company, Bitfarms, engages in the mining of cryptocurrency coins and tokens in North America, owns and operates server farms that primarily validate transactions on the Bitcoin blockchain and earning cryptocurrency from block rewards and transaction fees. The company also provides electrician services to commercial and residential customers in Quebec, Canada, and it also undertakes hosting of third-party mining hardware. The company was founded in 2017 and is headquartered in Toronto. Here's a brief a chart of recent price movements. So we can see that mid-June, was trading for about 71 cents during volatile period this past April, volatile period in the markets, was trading for about 64 cents, and now it's roughly 3x the 64 cents, trading for $1.92. So I did previously mention that a couple of days ago, it did pop up on my radar here for most active stocks in the pre-market trade. So I decided to get involved. And by the way, just as an example of demonstrating flexibility with asset allocation or where I'm going to deploy capital, until 2 days ago, I've never heard of Bitfarms. But since it popped up on the radar of most actively traded stocks in the pre-market, I decided to take a look at it, and I did decide to play in Bitfarms. Anyway, that being said, what I did is let me break this down by components. Okay, so September the 9th at 6:51 a.m., I purchased 5 of the calls at the $1.50 strike. I paid 8 cents for those. And then I decided to buy shares of stock, and you could see here that I bought 200 at $1.78, and I bought another 100 at $1.82, leaving me long 300 shares of the stock. Yesterday, I decided to buy puts at the $2 strike, and I bought 5 for 32 cents. So note that the sum of the options that I bought, 32 cents and 8 cents, totals 40 cents, and I am long the calls at $1.05, and I'm sorry, $1.50, and I'm long the puts at $2. So that leaves me with a two-legged box, in which the difference of the width of the box is 50 cents, which is simply $2 minus the $1.50, the strikes. So the difference in the width of the strikes is 50 cents, and I paid 40 cents for the box. So the box has to go out at 50, and I paid 40. I have 5 contracts, so no matter what happens, the box trade makes $50, $10 per contract, which is simply the box length, which is 50, minus the cost of the box is 40. It's $10 times 5 contracts is 50. Okay, now note that I completed the box by buying the puts at the $2 strike after the stock that I purchased rallied a bit. So the puts became cheaper as the stock rallied. And by the way, these are incredibly volatile right now. The volatility is very high. You can see that for this particular expiry, which is September the 19th, Implied vol is at $181, $181.3. So it's a very volatile stock for now. Getting back to the construction of the trade. So I have this component of it is just the options. So we have the box, 50 wide, guaranteed to be a credit. Now, if we add the stock that was purchased to this, let's look at what happens when we add the stock. I have 300 shares. So let's say that Bitfarms goes to 0. Well, the 300 shares will go to dust. They'll be worthless. However, I have 5 puts which kick in at the $1.50 strike, and they kick in at $1.50, not 2, because inside of the box, the long calls and the long puts cancel each other out. So I'm only going to get the $50 I mentioned, which is the credit I received for paying $40 for a box that has to go out at $50. Getting back to the stock here, the stock gets dusted if this goes to 0, so it'll be worthless. The stock will be worthless. However, I have 5 puts, so the share equivalency would be $500. So since 500 shares, so since the 500 shares exceed the actual shares in the underlying by 200, there's no downside risk. Let's look at the other side of the box. If it breaches the $2 area, or the $2 strike. Okay, so for everything above $2, I have the calls that kick in, which are worth 500 shares, and I actually have 300 shares. So this is this side, the upper end of the box. Anything beyond that, basically long 800 shares. So we'll note here that if the underlying goes to $3, I have a profit of $900, a little more than $900. So for every dollar that this goes up, I'm basically going to be making $800 for every dollar, and that would be long five calls, which is 500 shares, and the actual 300 shares of the underlying. And I do want to emphasize that I'm definitely not saying that Bitfarms is going to go to $4 or $5, $6 or $7. But every dollar that it does go up is worth $800 with this current position. I might buy more stock, and remember that the options expire next Friday. So if I'm still in this at that time, I'm going to have to make a decision about possibly rolling out in time. Whether I'm going to do that or not remains to be seen. But the nice thing about the way this is constructed is that there's basically no risk in the trade, and it's going to be a matter of how much money I make, which is going to be a function of movement into underlying. Right now it's currently trading for about $1.90, $1.91. And again, to the downside, I would basically have coverage on the puts which exceed the actual shares by 200. So I'm covered there. And then to the upside, I'm long 800. So we have the box plus long underlying shares, and I will make adjustments based on movement of the underlying. Okay, that's it for today. I will catch you guys next time.